Imagine this: with a single click, you could instantly own a small piece of Apple, Microsoft, Amazon, Nvidia, Google, Meta, Coca-Cola, JP Morgan, Visa, and nearly 500 of America's largest companies. It sounds expensive. It sounds complicated. But today, anyone with less than $100 can do exactly that. And the tool that makes it possible is called an ETF. This is possible because of something called an exchange-traded fund. Over the last 2 decades, ETFs have completely changed the way millions of people invest. Today, they manage trillions of dollars. But here's the interesting part. Most people know what an ETF is. Very few understand how it actually works. They rarely see the system operating behind every buy and sell order. They do not see how new ETF shares are created or removed from the market. They do not see the institutions working to keep the ETF price close to its real value. And that hidden machinery is what makes ETFs so powerful. Let's start with the basics. Imagine you walk into a grocery store. Instead of buying apples, bananas, oranges, and grapes one by one, you buy a fruit basket that already contains all of them. An ETF works in almost exactly the same way. Think of each company as a single building block. Apple is one block, Microsoft is another, Amazon is another. Individually, each block represents one company. An ETF puts hundreds of those blocks together into one complete structure. When you buy one share of that ETF, you immediately own tiny portions of every company inside it. You don't need to research hundreds of companies. You don't need to predict the next winner. The fund already owns them for you. One of the best examples is the Vanguard S&P 500 ETF, better known as VO. Instead of buying 500 companies individually, one ETF gives you exposure to all of them. But if buying one ETF gives you access to hundreds of companies, a much bigger question appears. Who actually buys all of those stocks? Who keeps everything organized? And where does your money really go after you click the buy button? Behind the scenes, an entire financial system begins working together. Companies like Vanguard, BlackRock, and State Street don't simply create ETFs and forget about them. They continuously manage them. If a company enters the S&P 500, the ETF buys it. If a company leaves, the ETF sells it. The investor doesn't need to do anything. But if buying one ETF gives you access to hundreds of companies, a much bigger question appears. Who actually buys all of those stocks? Who keeps everything organized? And where does your money really go after you click the buy button? Authorized participants can create entirely new ETF shares. Here's how the creation process works. First, an authorized participant buys the individual stocks that the ETF is designed to hold. It then delivers that basket of stocks to the ETF provider. In return, The provider creates a large block of new ETF shares and transfers them back to the authorized participant. As more ETF shares are created, supply increases. That helps keep prices close to fair value. It also reduces the chance that the ETF trades far above the value of its underlying assets. The creation process acts like a pressure release mechanism whenever demand becomes unusually strong. The opposite happens when investors rush to sell. If there are too many sellers, an authorized participant buys ETF shares from the market. Instead of keeping those shares, they return them to the ETF provider. The provider removes those ETF shares from circulation and gives the authorized participant the underlying basket of stocks. This process is called redemption. By reducing the number of ETF shares available, supply falls. This continuous cycle happens quietly every trading day. Most investors never notice it, but it is one of the most important innovations in modern finance. It keeps ETF prices closely connected to the value of the assets they hold, and it allows millions of investors to trade efficiently without managing every stock individually. Now let's talk about another concept you'll often hear: net asset value, or simply NAV. Think of NAV as the true value of everything. Inside the ETF, it is calculated by adding up the value of all the fund's assets. Then any liabilities are subtracted, and the result is divided by the number of ETF shares. Sometimes an ETF trades slightly above the value of the assets it holds. That is called a premium. When it trades below that value, it is called a discount. Authorized participants look for these small differences. They buy the cheaper side and sell the more expensive one. This process, called arbitrage, pushes the ETF price back toward its net asset value. That is why large ETFs usually trade remarkably close to their underlying value. Behind every simple ETF trade is an entire system connecting investors, authorized participants, ETF providers, and the companies inside the fund. Most investors never see it, but that system keeps ETF shares liquid, diversified, and efficiently priced. Different ETFs are built for different goals. VO tracks the S&P 500 and is commonly used for broad, long-term exposure to large American companies. SPY tracks the same index, but its enormous trading volume makes it especially popular with professional traders. QQQ focuses more heavily on technology and innovation, which can produce stronger gains but also greater volatility. VT spreads investments across thousands of companies around the world, and SCHD focuses on established businesses known for paying dividends. The structure is similar. ETFs are powerful, but they are not risk-free. Diversification reduces the impact of one company performing badly, but when the entire market falls, the ETF usually falls too. Investors should also consider fees, concentration, and tracking accuracy. The right ETF depends on the investor's goals. Remember three things. First, an ETF combines many investments into one tradable product. Second, diversification reduces company risk, but not market risk. Third, creation, redemption, and arbitrage keep ETF prices close to the value of their underlying assets. ETFs became successful because they made diversification simpler, cheaper, and more accessible. They do not remove risk or guarantee market-beating returns, but they allow ordinary investors to participate in the long-term growth of businesses around the world. And understanding ETFs is only the beginning. In the next episode, we will explore dollar-cost averaging, a simple strategy for investing the same amount regularly without trying to predict the perfect moment to enter the market.